All right, so I want to welcome everybody to Financial Wellness Online, the third session. You all please pray with me. Heavenly Father, once again, we come before you, bowed heads, humble hearts, and joyful spirits. We come before you to say thank you. Thank you for the time, the place, and the company. We ask that you would continue to be with us and to bless us and to bless our coming in and our going out, to make us ever aware of your presence, to allow us to become a source of hope and a resource for those around us, Father. Open our minds to the financial possibilities that you have laid before us, Father. It's my belief that you created financial markets so that we could have another stream of income. That Scripture says that the wealth of the righteous, of the unrighteous, will become ours, Father. And so we just want to celebrate the activities of trading and investing and allow us to go down this road and embrace these concepts together. Just thank you for those that are with us, and thank you to those who will watch these videos in the future, Father. This is our prayer in the mighty name of our Lord and Savior, Jesus Christ. Amen. All right, so once again, there's that tree, that money tree with the special money can, with the special money water. And you water that thing, and over time, you just have a tree sitting out there, and you just go out there and pick that money up off the ground. Our agenda, I'm not a financial advisor. I'm not giving investment or trading advice. I am not giving out tips. I'm sharing information. This is an educational presentation only. There are risks involved in trading and investing. You can lose more money than you have in your account. It's not easy. If it was easy, everybody would be doing it. And most of the people that do it lose money, okay? So that's my disclaimer. Tonight, we're gonna do a quick review, and then we're gonna look at what's out there for you to trade and what's out there for you to invest in. What are those financial instruments? Just a brief overview, a little information about savings bonds, since we had a question about that, and I'm gonna open up a trading platform. I will open up Thinkorswim for you to take a look at, and I'll take any questions, and then we'll talk about next week. So the review. Last week, the last 2 weeks, we talked about the first presentation. There was some information about value, and we invest for value, and it's not about price. There's a $50 stock and a $10 stock. The $50 stock is not worth more than the $10 stock. That's not, the price of a stock does not determine its value. The $50 stock could be lower than the $10 stock, okay? So it's a relative thing. And for me, when it comes to investing, I'm investing in yield. The yield is what I value, and I want to buy low. And low for me is 5-year lows. You can use, you'll find out what you want to use. You may want to use a 2-year low, 4-year low, 10-year low, 25-year low. It happens, okay? They hit stocks, good stocks hit 25-year lows sometimes. But so you will figure out what is value for you as you learn about all the many ways to invest. Same way with trading. Trading is more about buying low and selling high, or selling high and buying low. And we also, in the second session, we talked about risk. And from my perspective, if you buy $1,000 worth of stock, you're risking the whole $1,000. Now, more than likely, that's you buy a $50 stock, you get 20 shares for $1,000. More than likely, that stock's not going to drop down to zero, but it could happen. Okay. Now, when you will learn that when you put an order in, you can put an order in to buy a stock at a certain price. And if it never reaches that price, then your order won't be filled, and your money won't be risked in the market. In that same order, you could have, I want to get out if it drops down 15% or 10%, or if it drops down $1, and you could put a target. And if it goes up $10, I want to get out. You could structure your trade that way. But even though you got those targets in there, it doesn't mean that the price could jump up and hit you bought a $50 stock, you want to get out when it gets to 60, You got in at $50.50. It jumped, it hit your 60, but it dropped down, you know, the next moment to 40. They can do that. It hit your 50, your 60, but it dropped down, and you can get out at $40. So your money is always at risk if it's in the market. You could be up in a position, you know, you could be up $15 a share at the close of business on Thursday. Tomorrow, that stock could open up $20 low. So you would have lost your $15 of value plus, you know, $5 more of your principal that you put into the stock. So your money is always at risk when it's in the market. But there are some things that you can do to minimize the risk. And that is, you're in control of your money. You determine how much money you're going to put in. And if you're not comfortable losing it, then you shouldn't put it in. As your skill gets better, you'll be more comfortable to risk more and more money. As you become more aware of what market conditions and what you know, you're able to look at the market and see what big money is doing or smart money is doing. The ideal thing is to buy when everybody else is selling, believe it or not. You don't want to do what everybody else is doing. You want to be smart money, doesn't do what everybody else is doing. Okay, but you need to understand risk. Your primary job as a trader or investor is to be a risk manager. We talked about return on investment. Now, return on investment, you could have $10,000 in an account. You could risk it all every month, make $200 a month. At the end of the year, you made $2,400. Somebody else could take that same $10,000, put it in the trading account and only risk 10% of it and make the same $200 a month. And you both made the same amount of money, but the first person was risking everything. The other person is risking just $10. So the return on each account is the same, 24%. But the risk adjusted return is so much better for the person that's using $1,000 versus the person using $10,000. So when you're very good, you will risk a certain percentage of your account and you will make more. So if you risk 10% of your account and you make 15% for the year, that is you are an exceptional trader because you made more than you risked. You want to make more money, you just risk a little more. You could go up to 20%. You know, understand? So there's when you hear people talking about how much, oh, I made $1,000 on a trade. Well, how much did you risk to make that 1,000? You know, did you risk, you know, 100,000 to make that 1,000? It matters how much did you risk. So when you talk to other traders and investors, try and get them to talk about risk. Well, how much did you risk? One of the most successful traders, this guy named George Soros, he made $1 billion on a trade, shorting the British pound. But he risked something like $10 billion. You know, that ain't, to me, that's nothing. He made 10%. You know, you risk way too much money, if you ask me. So returning on investment, you must always consider the risk. How much did you risk? We talked about online charting tools. Uh-oh. Oh no. I see blank too. It says my internet is unstable. Hang on, let me see what's going on with the internet. It says I have access. Well, the online tools that we looked at was stockcharts.com, which it has a free section, and you can do some charting. And you can't hurt your computer or get in trouble going in there clicking on anything. Okay, just go in there and click, and they have stockcharts.com has a great educational section that will teach you about all the indicators. It's called Chart School. They will teach you about some strategies. They tell you how to use each indicator to trade. It's a great way to learn about technical analysis. It also has a, if you get the account that you pay for, you can do other things. But to start out, startcharts.com is a great platform to look at daily and weekly charts. Yeah, there we go. And most websites will have apps that can work on your smartphone. We looked at dividendinvestor.com, a lot of information on the free site. And we looked at FinViz, which has a great deal of information, fundamentals. It has a basic charting tool. Now, I had never tried the premium website, but I subscribed to it just so I could see what it offered. And you get a little better charting tool, but it's nothing. Stockcharts.com is better to me. And it has a back testing tool, which really only allowed me to do tests up through 2015. And if you do want to back test, that means you come up with a strategy to make money. I will hopefully show you one strategy tonight, a simple strategy to trade, just a very simple one. And you wanted to test that strategy, you could, some of those, you could put in some parameters and test that strategy on different baskets of stock, but it stops at 2015. If you are going to use a strategy to trade real money today, you need to be able to test it, up to today, okay? Because markets will exhibit different, a strategy that worked 10 years ago may not work today, okay? Now, markets exhibit different behaviors, okay? So, but we looked at online tools, and there's like I said, there's a bunch of them out there, and it doesn't hurt to go and explore. We looked at the differences between trading and investing, and the big one, I'm gonna play a portion of this little video, and we'll listen to what he says about the difference between trading and investing. Come on, Mr. Internet. Maybe not. The video is unavailable. Well, what do you know about that? Shame on him. Basically, there's two great differences. One is time. Investing, you're building wealth. You want to hold this product. Ideally, you want to buy it and will it to your descendants. Investing is about building wealth. So you want to buy something and hold it a long time. Trading is about income, and you want to hold that position long enough to make the income that particular strategy could make for you, okay? So trading, you at best 3-4 months is going to be the longest you'll probably be in a trade. But investing, you can hold it a lifetime. You could buy it. The goal is to buy it at a low enough price. Like there are people who grandparents have gifted them AT&T. The grandparents bought AT&T, 40 years ago. They're never gonna sell that stock. AT&T been paying dividends for 40 years, all that whole time. And they have no money risk in it. So they, if you have no money in a position, there's no reason to ever get rid of it unless it stops, they cut off their dividends altogether. But time, the amount of time you're gonna hold a particular financial position is different. And investing is about building wealth, and trading is about building income. So that was the quick review. Now we're going to take a high-level look at financial instruments for retail trading. Now, retail trading is what you are if you're trading from your home. You are a self-employed kind of sorta, and you are trading for yourself. You're considered a retail trader. Professional traders have a whole lot of help. They got all some people working for them, and they got usually those houses that have professional traders got a whole bunch of rules, and you know, they train it, so it's totally different. And they have a different set of rules that they have to live by. When you get your brokerage account, it's going to ask you, do you have a broker's license? It's going to ask you, are you a 10% stockholder in any company? It's trying to figure out, are you a professional or are you retail? Okay. So we are considered retail traders, and there's some things that professional people can invest in, trade in, or there's this term called accredited investors. There's some things that unless you have a whole bunch of money, they won't even let you risk your money in it, okay? So I'm gonna talk about instruments for retail trading. In this picture, you see stocks. Used to be paper. Stocks not paper anymore. It's electronic. Bonds are pretty much the same way. They don't even issue the paper savings bonds anymore. It's all pretty much electronic. You can actually trade real estate. We'll talk a little bit about that. Cash is not used for trading. You can invest in cash products, but the return is going to be very low. Commodities, you can actually, there are some markets for when it's going to snow. With the first day it's going to snow, and you can go. It's some exchanges are set up for people to go gamble. Okay, it's just a bet about what's going to happen in the future. And that's really what we're doing too, right? If I buy something and I expect it to go up, I'm betting that it's going to go up. Okay, but when you learn how to trade, your bet is based on the market favorable conditions. I've seen, I back tested this, or I practiced this. I've seen this. I've talked to other people about it. They've seen it, and I can visually see this. And if I'm wrong, I won't lose all my money. I'll lose a little bit of money, and I can go and try it again. And if it doesn't work, then I can go and research and figure out what do I need to change, okay? Some folk just hear something and they go buy, and that is speculation, that's gambling. We're talking about retail trading, where you're gonna not risk all your money. You're gonna have money control rules. You're gonna follow your rules. You're gonna journal about your trade. You're gonna write down why you wanted to buy or sell this particular item. You're gonna have targets that says I'm right, or target that says I'm wrong. And you will assess, there's different little formulas you can use to see how good or how bad you're doing, okay? Commodities are mostly futures contract, and we'll talk a little bit about those. Now, private equity, there are some ETFs that follow private equity type stuff. So you can, using ETFs, you can participate in private equity. And then there are these devices called BDCs, business development companies. That's all they are. And they tend to pay a good dividend, but those little companies are investing in startups, and they help businesses turn around. So there is a way for retail traders to participate in the private equity arena. So let us take a look at this list. Now I'm going to post this presentation. These are the instruments for retail trading. And this is about producing income once again. We're going to buy a stock, and we're not trying to hold it for 5 years and give it to our grandson when we die. We're going to buy this thing when it's low. When it gets high and it looks like it's about to go down again, we're going to get out of it. And then we're going to go look for another one, okay? We're not going to watch that one to see what happened. Oh man, I shouldn't have got out. You got in at $10, it went up $5, you got out at 15, so you made $5 a share, and you don't look back. It may continue going up, okay? If you have a reentry strategy, you can re-enter. If you don't have a reentry strategy, you go and find something else, okay? Income producing, we're trying to produce income. When you buy a stock, you hear that you own part of the company. You own part of the company's what's called shareholder equity. You own part of the equity, okay? You don't own the assets. You know, you don't own the inventory. You buy a share of Apple, you don't own none of the Apple inventory. You just own a share of Apple's shareholder equity. That's it. Now, if you, and you get to participate in the movement of the stock. It has the only thing that impacts it directly is the price. Okay. Now, the price of a stock is influenced by a lot of things. Like the CEO could die and the stock could plummet, or the CEO could get caught up in a scandal. Okay. Those are types of risk associated with buying a single stock. Interest rates could change, and that stock could be very sensitive to interest rates. You know, a president could get assassinated, or a jet could run into the towers. You know, 9/11, the stock dropped like a brick and the stock market was closed for several days. And when the market opened back up, your position started, whatever had happened doing, you know, if your market is closed, you can't get out of your position. Okay. That's why you have to be willing to lose, because you never know what's going to happen. You never know. So that stocks allow us to participate in what people think about that company. Now, the stocks be going up and down all the time, and the company's not even changing. But the prices are driven by our perception of the future. You know, for the longest, Netflix didn't make any money, but the stock was going up. Amazon wasn't making that much money in the beginning, but the stock kept going up because of people's perception of the future. If I feel that this company is going to be earning big money in the future, like Tesla, for many years, Tesla didn't make any money. It's only been making money maybe for the last, 5 or 6 quarters. Elon Musk's personality and the great potential, if we could ever get electric cars, kept people buying Tesla stock. Stocks are driven up because people think what they think about the future, and they go down because of what they think about the future also. Now, technically what's going on when a stock goes up, there are people that want to buy it because people like to buy low, but people like to sell high, right? So if a stock's at $10 and I own it, and I'm not going to sell it unless it goes to 11. And everybody who wants to sell at 10, they done sold it. So there's no more sellers at 10. The stock will go up 10 and a quarter. If there's some people that want to sell at 10 and a quarter, it'll sit there for a while. If there's nobody who wants to sell at 10 and a quarter, it'll go up. Stocks go up looking for sellers. There's people who want to buy it, but nobody wants to sell it to them at that current price. So it goes a little higher to see if there are some sellers, and there's some people that are willing to buy it at that higher price. And the price of that stock will continue to go up as long as what's called buying pressure is more than selling pressure. So the only reason any financial instrument goes, well, not the only reason, we can't say that. We'll just stick with stocks. The only reason the price of a stock goes up is because there are people that want to buy it, but nobody wants to sell it at the current price because we like to sell high. So it has to go higher and higher and higher. Eventually, everybody that wants to buy the stock has bought it. Nobody else wants to buy it. So now we're sitting at $15 and there's no buyers at 15. People like to buy low, right? So what do you think the stock, there's people that want to sell, but nobody wants to buy at 15. So the price starts going down, looking for buyers. And the emotional drive of the buyers and sellers is all about what we think about is going to happen in the future for this particular stock. Okay. They are easily bought. Some of them are trade millions, hundreds of millions of shares a day. I'm amazed sometimes. And there's lots of information about, most of the big companies. So the New York Stock Exchange, the NASDAQ exchange are the primary, and the American exchange are the primary exchanges that sell the US stocks, but there are exchanges all over the world. As you begin, I recommend that you stick with US stocks. And once you become comfortable with those, you can start branching out all over the place, okay? Bonds are, when you buy a bond, you're loaning money to the bond issuer. So let's say that Apple wants to raise some money. Apple could issue some more stock, but companies don't really like to do that, because if they issue more stock, now you got more people that have a say-so about the equity, about, and if you get enough of those shares, you have a right to be heard to try and direct the company how it wants to behave, okay? So the easier way for companies to gain money is to ask people to loan it to them. Bonds are usually sold in $1,000 increments. So you could go and buy a bond. We'll pick on Ford. Ford wants to issue a bond, and they're going to pay 5%, and the bond will, in 5 years, they want to close this. They want to pay off all their debt. So you give them $1,000, and 5% on $1,000 is $50, and they pay this interest usually every 3 months. So every 3 months, you're going to get $12.25. That's a fourth of that 5%. So for 5 years, every 3 months, you're going to get $12.25. At the end of the 5 years, Ford is going to give you your $1,000 back. So when that bond matures, they give you your $1,000 back. You got to keep all the interest that they gave. You got to keep your $50 a year, you know. And the beauty of that bond is, regardless of now bond prices, if you buy that bond at $1,000 and the interest rates go up, that makes the price of the bond go down. You could sell your bond in the secondary market, but interest rates will make that bond price go up and down. But if you hold that bond and the issuer doesn't go bankrupt, you're going to get your interest and you're going to get your $1,000 back. So stocks are going up and down, and a dividend paying stock is not legally bound to pay dividends, but a bond issuer is legally bound to pay that bond interest. If they don't pay that interest, they're in trouble. They're gonna have to, they will get seized, and bond holders get paid before stockholders get paid, okay? Bond is a senior instrument to stocks. So when a company goes bankrupt, the assets are sold off and bond holders are paid first. If there's anything left over, there's different level of stocks, okay? But stockholders get paid after bond holders get paid. So that bonds are a little more, have that seniority to the stocks. That's why a lot of people just buy bonds. And if you should buy a bond that's paying an interest that you're satisfied with. And I recommend that you hold the bond till it matures. So once again, I'm all about yield and interest. So if I'm happy making 8% on this bond, then, you know, regardless, the bond price will change. If you wanted to sell it to get out of your bond position, it's going to change based on interest rates. But if you hold it, you're going to get what you were promised at the beginning, as long as that company doesn't go out of business. Now, they do go out of business sometimes. During the Great Recession, a company called Bear Stearns had been around for 160 years, had all sorts of bonds and these very complicated financial products out there. And when the real estate market turned against them, they end up, you know, not being able to pay, and their stock, you know, dropped off, and the stockholders got a little bit of nothing, but some of the bond holders got paid. Other financial institutions came in and bought their stuff, you know, pennies on the dollar. But so bonds are in some ways safer than stock, but you are limited on how much money you're going to make from it. There's a fixed amount of money you're going to make on that bond when you buy it. But they do, like I said, if interest rates go down, if you buy a bond that's paying 5%, interest rates drop down to 2.5%. Now, and you wanted to sell that bond, If somebody bought $1,000 bond at 2.5%, they're only going to get what, $25 a year. Your bond's paying $50 a year. So they're going to have to give you $2,000 for that bond, because 2.5% of 2,000 is $50. So you can sell your bonds for a profit if interest rates go down. And you can sell that bond on the secondary market before it matures for a loss if interest rates go up. But if you hold a bond to maturity, you get everything you were promised in the beginning. And that's why a lot of financial advisors will tell you, as you age, you should shift more and more of your portfolio into bonds, because you will have a fixed income. They're called a fixed income instrument. If you hold them to maturity, you're going to get a fixed amount of income. You know how much money you're going to make on those things when you buy it. Okay, so that's what a bond is. And the bond market, believe it or not, is much bigger than the stock market. The bond market dwarfs the stock market. There are more bonds out there than there are stocks, believe it or not, because cities, municipal bonds are out there, and you're not going to trade municipal bonds. Okay, they move very little. They don't move enough to trade. They're more of an investment product. And you know, to trade bonds successfully, you're going to have to buy a lot of them. Okay, and then you're betting on interest rates, because you may remember when trading, you're either buying low and selling high, or you're selling high and buying low. Okay, so if you're betting on what interest rates are going to do, bonds are a great tool to trade. They're more of an investment tool. Uh-oh, what is that? Do we have a hand, a question? A chat. Okay, let me look. Chat. Where can I buy bonds? Okay, you can buy bonds. Like I have a TD Ameritrade account. I have to go to the website to buy the bond. I can't buy the bond from my Thinkorswim trading platform. I have to go to the website. You go to the website, they'll have a link you can click on to see the bonds that are off for sale that I can get through TD Ameritrade. And you can go, so it's your broker website is typically where you buy bonds at. And they got, like I said, there's all sorts of bonds. They usually have tools that allow you to search. I want to see bonds that are paying 8% or higher. And you only get to see the bonds. And I want to see the bond 8%, but I want them to mature in 3 years. So you'll get to see those specific bonds. And then you have to go do a little research on the company to see if you think this company is going to be around. Because the higher the interest rate that a bond pays, the less financially sound the company is. Like Apple got, $100 billion in the bank. I don't know why they sell bonds, because they got money. But on an Apple bond, you're probably only going to be getting like 1 to 2, maybe 3% tops, because Apple is considered, the Starship Enterprise. She is not going to go out of business. They are Microsoft is another company. Their bonds are not going to pay much. But a company like Ford, automobile industry is in trouble. So, electric vehicles could take them out. So Ford, you may be able to get a 9% bond from Ford. Okay. Name a few brokers: TD Ameritrade, E-Trade, Charles Schwab. Those are the 3 that I'm familiar with. There used to be some more, but Charles Schwab done bought up a couple of them. Charles Schwab actually has bought TD Ameritrade, and that is hasn't finalized yet. But those are used to be Scottrade used to be one, but Charles Schwab bought Scottrade. Options Express used to be one, but Charles Schwab bought them. Merrill Lynch used to be out there. You can probably get a account with Goldman Sachs if you got a lot of money. But starting out, I would, E-Trade, TD Ameritrade, Charles Schwab. Those have a lot of free tools and a lot of education, a lot of little short videos. They even have a sequence. Some of them have a sequence that they recommend that you go through them in a certain sequence, because they're successful if you can keep trading. They make money when you trade. Brokers make money when you trade. If you go in with $10,000, they're not allowed to, used to, if you wanted to buy, if you were a new trader and you wanted to buy something, the broker would sell it to you, because new traders lost money. They would automatically take the opposite side of your trade. They can't do that anymore for stocks and bonds and futures contract. Now in the Forex market, they can do that. A Forex broker can take the opposite side of your trade. And, you know, I don't know why that is, but Forex brokers are allowed to do that. Okay, so Charles Schwab, TD Ameritrade, E-Trade. I have looked at Charles Schwab, and I'm a current, have accounts with TD Ameritrade, and those will have bonds. Now there's a lot of other trading platforms that will not have bonds, that they're just for trading. They're not for investing. Like Thinkorswim is a trading platform. It is not for investing, okay? The next item that I like to talk about is futures contract. Futures contract is a leverage instrument, meaning that I don't have to, I put very little money up when I purchase it. They actually just freeze money in my account and let me control this contract. If I sell a futures contract, I'm betting that the price of that futures is going to go down. If I buy it, I'm betting that it's going to go up. And they are time sensitive. They expire after a certain period of time. And at the end of that contract, at the end of the expiration, you either got to roll it over into another contract or just you know, get out of that position at whatever price that the futures contract is at. To give you an example, if there's a futures called the E-mini, it tracks the S&P 500. It ticks up by what is it, a quarter. It goes up a quarter at a time, and it goes down a quarter at a time. If it goes up $1, I make $50. If I bought a futures contract on the E-mini, and the E-mini futures goes up $1, I just made $50. So that's a 1 to 50 leverage. If it goes up $1, I make $50. That's the beauty of the futures contract. It's a leverage instrument. Right now, they hold about $13,000 for me to own or control one futures contract, and I want to hold it overnight. I have to let them freeze $13,000 in my account. About 3 or 4 years ago, it was 6,000, 5,000. But because of the Great Recession, the market was swinging around so much, and we got so much volatility now, they increase it. Because if that futures contract moves against me, you know, let's say it dropped 20 points, that's $1,000. Let's say it dropped 100 points.
Image message from Charles Hudson.
That's $5,000. So it can, if it moves against you, it can, and if you don't have enough money in your account, they will freeze your account and try and get the assets from your futures contract. If your futures position, you can lose more money than you have in your account. So before you trade futures, you really have to know what you're doing. Forex is foreign exchange. It's all about currencies. You're buying currency pairs, or you're betting that one currency is going to go up and the other one's going to go down. So I can buy the Japanese yen and the US dollar currency pair. If I buy that, I'm betting that the Japanese yen goes up and the dollar either goes up a smaller amount or goes down. So you can make money with this thing. If the Japanese yen goes up and the dollar goes up a smaller amount, I can still make money because that pair, the Japanese yen, went up more. If the Japanese yen goes up and the dollar goes down, I make a lot of money, more money. If the Japanese yen goes down, but the dollar goes down even more, I still make money by owning this currency pair. The Forex market is bigger than the bond market and the stock market. It is the largest market in the world because it's money. Every day, money moves, and it moves between nations through the foreign exchange. But these brokers are not regulated like the futures brokers, bond brokers, and the stock brokers are. They're not regulated. And so there's you really gotta know what you're doing when you go into the Forex market, because the brokers can take positions opposite of you, okay? Futures contract, they can't do that. So now a lot of countries, the first thing people learn to trade is a Forex for some reason. A couple of schools I went to, when they teach overseas, people start with the Forex. I don't recommend that you start with the Forex. I recommend that you practice with stocks and eventually learn how to trade bonds. Options, own stocks and ETFs. And once you get really good, go to futures contracts. The fifth item there are exchange traded products, there are ETFs and ETNs, exchange traded funds, and exchange traded notes. They're similar, but they're different. The exchange traded funds, we'll use one called the SPY, that's the symbol for it. It tracks the S&P 500. The sponsor of the SPY has to go out and buy stock. They have to go and own every stock in the S&P 500. So the ETF is backed by stock. The ETN that tracks the S&P 500 is backed by nothing other than the good faith of the issuer. He says that, hey, if the S&P 500 goes up 1%, then this ETN will go up 1%. And if you want to sell it to me, I will pay you, okay? But it's based on, he has nothing but his good name, like a bond issuer. A bond issuer just has his good name and the assets of the company. And so the ETN is related to bonds in that it is actually a debt instrument, but it trades like a stock. And it has some pros and cons. The internet would tell you all about that. Me personally, I have a basket of ETFs that I monitor, and I trade options on those ETFs. And those ETFs, some of them have a corresponding futures contract, because I hope to eventually shift over to futures contracts. Okay, so ETFs are passively managed. They just want to do what the S&P 500 does. They're not trying to beat the S&P 500. The ETFs and the ETNs, they're trying to mimic whatever their underlying benchmark is. There's ETFs for banking, oil, any sector or industry you want to think of, there's an ETF or an ETN out there for it. And they're passively managed, so their expenses are terribly low. Are there any questions about anything I've said right now? And you know, time is going to get away from me. It's almost 8 o'clock, and I haven't even finished this list. Real estate can be traded. That's what kind of sort of brought on the Great Recession. There were people who left their good paying day job with benefits to trade real estate. They would go buy a piece of property, fix it up, and sell it. So they would buy it, they spend 2 months fixing it up, and then they would sell it. And that's a trade. There were people that would go and put in, there's a house that's been sitting on the market for, you know, a couple months and sold. I could walk up to that seller and say, look, I want the option to buy this house. I'll pay you $3,000 if you give me the option to buy this house, but give me 6 months to do it. So the seller says, okay, give me $3,000. That person who gave the $3,000 would go and find a buyer. The seller is selling the house for $150,000. I go find a buyer that would buy this house for $175,000. So that's a $25,000 difference. I get the difference minus my $3,000. So I spent $3,000, but I made $20,000 difference, and I did it in 4 months. People were doing that. That's trading real estate, and they quit their day jobs to do that. And there was this belief that real estate was going to go up forever. Sort of like the belief that the stock market is going to go up. The stock market has been going up a long time. There's this belief that the stock market is going to go up forever. But, real estate went down all over America at the same time. That hasn't happened in a long time. But you can trade real estate. I don't recommend that, but it can be done. So all these items up above have options on them. Stock has options. You get options on some bonds. Some futures contracts have options. Some Forex currency pairs have options. Some ETNs and ETFs have options. And you can get an option on the real estate, as I just described. Options allow me to control the underlying, but I don't own it. And so I can control 100 shares. I can buy one contract of an option on Apple, and that allows me to control 100 shares of Apple. There are options that make money when the market goes up. They're called call options. There are options that make money when the when Apple goes down. Those are called put options. And then you can combine options in all these different ways. And there's a lot of strategies that can be done with options. And I would recommend that in the beginning, you just look at buying calls, buying puts, and until you get a great understanding of options. You have to go get education on options, or sit with somebody and watch them use options before you can fully understand. But they are powerful tools. A put option is how you can insure your stock. For example, if I got a stock, I bought it at $50, it's now at $100, and I think the market's getting ready to go down. If I buy a put, let's say at $95, and I buy it, these things are time sensitive. I buy it where it's active for 3 months. So a put, if I buy a put, I have the right to sell that stock at $95. It could go down to $2. I can sell it at $95. Okay, that's how you insure your stock, by using a put option. And people do that. If you got, $4 million in your 401k, you insure your car every month, you insure your house, you should look at insuring your $4 million, because your car is what costs $30,000, $40,000 maybe. And we insure it. And we don't think two hoots about that premium we pay. We don't miss it. But very few of us will insure our 401ks and our IRAs. There are these options called binary options. There's only one exchange that I know of in the US. It's called NADAX. They are regulated by the same people that regulate futures contract. But you need to get training about binaries before you engage in them. They have binary options that you'll know if you made money in 20 minutes. Some of them, they may even have down to 5 minutes now. You're betting that the whatever you buy or sell on is going to move in a short period of time. They go up to a week. Very simple once you understand them. And number 9, you've all heard of cryptocurrencies. And I would, that is the newest financial product out there. And all financial vehicles are driven by that buying pressure and that selling pressure, okay? All of them, it doesn't matter what it is. the car dealers. When you go to buy a car, if nobody's buying that car at, $5,000, they're going to lower the price of that car because they're looking for buyers. People like to buy low. Cryptocurrency is the same way. They're just extremely volatile right now. And there's so many of them. And they're not regulated. So you may want to stay away from cryptocurrencies. So my advice to beginning retail traders is to practice with stocks and ETFs, and then learn about options, and then practice with options. Because there are option positions you can put on with $100, with $25, with $50. So once you start wanting to put real money to work, options are a real inexpensive way to do it. Put $1,000 in an account. Say I'm only going to put no more than 10% in any one position. I'm only going to do 2 positions max. So, and if both of them go against you, then hey, I got $800 more to keep practicing. So I recommend that, a year of virtual trading of stocks, ETFs, and then another year of virtual trading with options on stocks and ETFs. And then you can start doing real money. I would recommend that either you start, either you're going to be buying 1 or 2 shares, or you can start with options, buy 1 or 2 contracts, and the price is very low. So that's a quick overview of retail trading financial instruments. The ones I recommend again is to spend your first year practicing with stocks and ETFs, buying and selling. And you'll learn about shorting is how you sell first and then you buy it back. So you sell it at $100 and they put that $100 in your account when you sell it and it's yours. It drops down to $40. You buy it back at $40. You get to keep the difference, which is $60. So you sell and you don't even, you borrow it. The brokers have certain stocks are shortable and they will allow you to sell them. And you buy them back at a lower price and you get to keep the difference. That's how you make money. Every stock is not, an ETF is not shortable. Some are. The more efficient way to do that, I think, is with options. That if you buy a put option and the stock goes down, that put option goes up in value. So instead of shorting, because if you short a stock, say you shorted at 100 and it jumps up to 150, you now owe $50. So, and a stock can jump up to an unlimited high value. So that shorting a stock, you can lose more money than you have in your account. Okay, that's one way you can do it with stocks. But if you buy a stock, you can only lose the amount of money that you paid into it. So I do not recommend that you ever short a stock until you have to be, very, very good at what you're doing to short something. Okay. So I'm gonna go quickly into instruments for retail investing. Some of them are pretty much the same ones we've already talked about. You can invest in cash and treasury bills are very short-term bonds, debt instruments with the U.S. government. They're less than a year, usually 1 to 3 months. It's considered cash. You get very little interest. These savings accounts pay very little money. All these pay very little interest, but they are safe. Savings accounts and money market and CDs are insured by the FDIC up to $250,000. And if you have more than that, I showed a little video about CDARS. You can just use CDARS and they'll spread that money around. So all your money can be FDIC insured. Once your emergency fund, let's say you get an emergency fund that's big enough to cover your expenses for a year, I would recommend that you put some of that money into a money market account or a savings account that's paying the highest interest you can find, or maybe even CDs, but you need to be able to, the CD ladder, I mean, you buy one CD that is good for, that matures in a year, 2 years, 3 years, 4 years. So every year you got one maturing and see if you need it, okay? So just, go to the great internet and ask it about CD ladders, and you can get some more information about that. We talked a little bit about bonds. Their corporate bonds are issued by companies, and then government bonds. All levels of government issue bonds, cities, counties, states, federal, some US agencies will issue bonds, and international entities issue bonds. So there are bonds out there. There are some tax benefits to treasury bonds and municipal bonds. But the yields are going to be very low on government bonds. Some corporate bonds are very high. The higher it is, the riskier that bond is because of the financial condition of that company. There are rating agencies for bonds, Moody, Standard & Poor, AM Best, and they all got it wrong during the Great Recession. The financial products that took the market, took the economy down, and had been blessed by these agencies. They thought they were okay. So they all were, drinking the Kool-Aid. Okay, if you go and access this link, these things that are underlines are links, and it will take you to some web pages that will give you a little more information about these things. Bullet shares and I-bonds are ETFs. The company goes out and buys a basket of bonds, but they're time sequence. Okay, meaning you can buy one that ETF is going to mature just like a bond on December 31st. So you can go out, they usually sell them all the way out to like 5 or 6 years out. So you can buy one that matures December 31st of 2020, 2021, 22, 23, 24, 25. They pay different amounts of interest, but the interest is going to vary because of the basket of bonds that they have. So you're not going to get a guaranteed interest rate from these bond ETFs, but they do mature just like a bond. They will. So let's say I got 1,000 shares. I paid $20 when I got in. If the bond fund, and I get interest 4 times a year, and when that bond reaches its maturation date, if the shares are now $25, I'll get $25 a share. But if they're $15, I get $15 a share. So there is a risk that I won't get all my money back. But these things been around less than 10 years. And if you go and look at and so these 10 years, we've all been going up in this great bull market, right? So, I don't know how they would have fared during the Great Recession, but I think they are great tools, and they have the same ladder. You can get one that expires, 1 year, 2 year, 3 year, 4 year, 5 year. And it's a great place to put your money, I believe, while you're learning to trade. Just buy yourself some bullet shares and spread it between different years. And, I tell everybody in 7 years, we ought to be able to learn how to do anything that's doable that's doable if we apply ourselves. So save your money in cash items. I would recommend look at bullet shares or I-bonds before you go to individual bonds, because they're going to buy a basket of bonds, and one company may go under, but there's another 190 bonds they got that didn't go under. If you happen to go out and buy an individual bond, you may buy the bond of the company that goes under. So you get a diversified basket of bonds with bullet share bonds and I-bonds. There are mutual funds that are bond funds, but they never mature. They never mature, and you lose a bond is meant to mature, and you get your principal back, and you go put it to work someplace else. A mutual fund is a bond fund, or ETFs. There's some ETFs that are bond funds. They don't want you to take, they don't want you to ever get your principal back, okay? But bullet shares and I-bonds are designed to put that money back in your hand once that bond matures, that fund matures, so you can put it to work someplace else. It's a great place, I believe, to park your money, okay? That's bullet share bonds and I bonds ETFs. Stocks is a great vehicle for building wealth, but I believe you need to be getting dividend paying stocks or value stocks. That means you buy them when they are dirt cheap. You have to learn how to determine when a stock is valued though. Dividends are about looking at the yield and assessing the company, and there's lots of tools to help you do that. But value, when stocks are beaten down, they're usually beaten down for a reason. You got to find the one that's beaten down and shouldn't be. They're still making money, you know, why they get beaten down, you know, but they're going to come back in favor. Like oil, there are lots of oil stocks that have been beaten down because of Saudi Arabia and wanted to put a bunch of US oil companies out of business. So they just start pumping oil like crazy, drove the price down, and a lot of US oil companies had to shut down. That's why oil stocks are depressed. We still use a bunch of oil, okay? So you have to learn how to find value stocks. Dividend stocks are easier to find than ones that pay dividends using a lot of web-based tools. ETFs, we talked a little bit about those, great investment vehicles. There's some out there if you want to invest in semiconductors. There are ETFs that's all they have are stocks that are in semiconductors. You can find an ETF to reflect what you want to invest in. Closed-end mutual funds, it's sort of like an ETF. ETFs and mutual funds can issue an unlimited number of units. They can keep issuing and issuing and issuing. Closed-end mutual funds can't. They have an initial public offering, and that's it. And they are actively managed, and they can't issue more shares. If they do, they have to do a second offering, and there's a process that the company has to go through to do that. But they are meant to, you know, no more. We're not going to issue any more shares, and so the price of those closed-end funds, once again, can be driven higher than they're actually worth if you look at the stocks that were in it. The stocks, when you add all the stocks up together and divide it by the number of shares, maybe it says that this closed-end mutual fund should be worth $15. But because so many people like it, because the closed-end funds pay a lot of dividends. They are high dividend paying entities, okay? That's what makes them attractive. So sometimes they're selling at a premium and some of them are selling at a discount. And that plays a role in this market. Like I said, I'm just throwing a bunch of stuff out here and it means nothing to you right now. It's just proof that you need to go study these things. And you can ask the great internet, teach me about closed-end funds, and it will, okay? There are these things called real estate investment trusts. They own real estate. And they were told the federal government that they're going to take 90% of their earnings and distribute it to their shareholders, so they don't have to pay any tax. So great source of income. Many of them have very good dividends. It's a great place to look to build wealth. BDCs are the same thing, business development companies. They get that same tax treatment because they're going to pay most of their profits. They're going to send them out in dividends to their unit holders. BDCs are newer than real estate investment trusts, but they tend to pay good dividends. Now, I don't know that much about them. The REITs, I do. I look at them. Been looking at some of them for 10 years. But the REITs are a good way to invest in real estate without actually going out and buying an apartment building. There's a REIT that owns apartment buildings, okay? BDC is a great way to participate in venture capitalists. Some of these little businesses that they're helping are going to take off and become great. And that BDC will go up, make money from that, okay? But they are great instruments for building wealth. You just got to go learn about them. Real estate, great. The good thing about real estate is the bank will give you money to go buy some. Banks aren't going to give you money to go buy ETFs or REITs or BDCs or bullet shares, but they would give. You can go to the bank and do it before the Great Recession. You didn't even have to put money down. Every piece of real estate I bought, I didn't put a penny down, which is crazy. I didn't put a penny down. The bank fronted me all the money to buy them homes. And, you know, we rented them out. But it was crazy to me. Well, I didn't know no better. But of all these entities, real estate is the only one the bank is going to give you money to go buy. Well, they may give you money to go to do a business also. If you're going involved in a business, they may give you money to open up a business. But real estate is the bank loves to own mortgages. They love it. They love owning mortgages because it's secured by the real estate. Okay. Great way to make money if you're going to rent it out. Okay. You wouldn't want to buy a house, you know, in a neighborhood where houses have been doubling every 5 years. You wouldn't go buy one of those houses and let it sit there empty for 5 years and then try and sell it twice the price. Wouldn't make any sense. You want to rent it out. You want to rent it out at a high enough value where the rent will cover the mortgage and your other expenses of being a landlord. And then throw you off a little positive income. That is, you want positive cash flow real estate. And you want to use the bank to finance as much of it as possible. Number 8, believe it or not, cash value life insurance can be an investment tool. If I had it to do over, I would go out and buy a whole life policy for as much as I could afford when I turned 25. As much as I could afford. But I would want it to be paid up in 20 years. And as I made more money, I get more coverage. And I would want it to be paid up in 20 years now. You know, I would be 45 years old with a $500,000 insurance policy paid up. And you can buy paid up additions that will pay a higher interest rate than your cash accounts up here. And you can borrow from these things and you don't really ever have to pay them back if you don't want to. You can pay them back. You're paying yourself back. So you can actually borrow from your cash value life insurance and buy your car. And then pay yourself the car payments to pay the policy back, okay? I think it is I think this is the first investment tool that any young person should invest in, is cash value life insurance. And then buy their first piece of real estate with an eye toward moving out of it in 5 to 10 years and renting it out. There are these life insurance products called annuities. Annuities in the 21st century are much better than the ones from the 20th century. They can guarantee that you won't lose principal. If you do make, you can get a fixed income that's kind of low now because interest rates are low. But there was a time when you get 5-10% fixed. You can get them tied to the S&P 500. And there's different ways of tying. So if the S&P 500 goes up for 20 in 2018 or whatever your policy year is, let's say it goes up 10%. They add 10% to your principal. The next year it drops 10%. That annuity is guaranteed not to drop. So then not only can they guarantee your principal, they can guarantee that if you do make money and the market goes down the next year, you won't lose any money. So I think annuities are great vehicles for building wealth. And you can assign beneficiaries, and they can, when you pass, any principal that's left in the annuity passes on to the people that you put in as your beneficiary. So annuities, I think, are an important role for, especially if you get big lump sums out of the blue sometime. I wish the Navy, I could re-enlist in the Navy, and the first time they gave me a check for $12,000. I had no idea what to do with it. I can't even tell you what I did with it. That is so terrible. But we want to raise up our children to understand that you could go stick it in an annuity. I think I was 1980, so I was 21 going on 22. Imagine if I stuck that 12,000 in annuity. Back then, you could get them paying 8, 9, 10%. And then sit there for 30 years and add more to it. But anyway, annuities are a great way to build wealth. Now, probably the most unlimited way is to go into business. The internet has made this easier and easier. Okay. But a business is a wealth building tool and worthy of investment if you know what you're doing. So I've ran through this list kind of fast. These are things that you need to learn something about if you choose to use them. For in wealth building, I would recommend, as I said, a young person, cash value life insurance, buy your first piece of real estate with an eye toward renting it out. You want to buy it in an area where you can rent it. Get some annuities going in your life. Annuity is your own retirement fund, is what it is. And then learn about buying dividend paying vehicles and learn about bonds. And REITs and BDCs pay dividends. So the REITs, BDCs, ETFs that pay dividend, closed-end funds pays dividend. I personally don't like mutual funds. Now, most 401ks, that's all you got. They, for whatever reason, they don't have ETFs in there. I can't understand it. But a mutual fund, when you say, oh, I want to buy $1,000, I want to put $1,000 in mutual fund, they can't even tell you. You got to put your order in not knowing how much it's going to cost. If your order doesn't go in before 4 o'clock, they won't accept it. And because mutual funds only quote their price after the market close. And same way when you sell, you don't know what you're going to get. We wouldn't buy anything else. We wouldn't buy a house, a car. We wouldn't even buy a television. If I said, oh, I want that television. Well, you're going to have to obligate to buy it without knowing how much it's going to cost. We wouldn't do it, but we do it with mutual funds. And in 401ks, we have no choice, typically. They also have fees. They of all these instruments, they have the highest fees. Mutual funds have the highest fees. They are actively managed, but most of them don't beat the S&P 500. So mutual fund is the least liked of all these things that I've shown you, okay? For the reasons that I have outlined. And we're going to do a quick look at savings bond. And then I think that's going to lead us into any questions. So what I got here are 2 links. I'm going to go, this one takes you to the US Savings Bond website. This is going to take us to a little guided tour, and we will step through that. So it tells you how to open an account, complete the application, and your account is open. Number 2 talks about how to buy securities. And once you open this, you can buy more than US savings bond. You may not be able to, let's see if I can make this a little bigger. I'm actually making it bigger for myself. But you can buy, you see, savings bond. And there are no more paper savings bond. But this is how you would buy them. You would click what you want, you would review and approve it. Now you can buy Series I savings bond with your income tax return. You can tell them to invest your entire income, or maybe even a portion of your income tax return in Series I savings bond. Let me make this a little smaller now. This tells you how to manage your account. So like I said, the internet is just filled with great information. Because I just asked, tell me about, I say, I want to buy some savings bond, and boom, I got those two little websites. There's a lot of information there, okay? And that is the only way to buy savings bond, is through what's called Treasury Direct. I don't think they don't have the payroll plans anymore. They had a nice little history of saving bonds that was very informative. And the last thing I want to show you is, I'm not gonna have time to do it. I'm sorry. We're gonna have to do this next week. I done run out of time. I'll open up my trading platform the first thing next Thursday, so I can show you an actual trading platform. And this is for trading. And I'll open up the TD Ameritrade and we'll look at buying bonds. Now I know I ran through that, but I just wanted you to get this is a high level overview of what's out there. So now, Renee, you can ask your question out loud, but I'm gonna read it. It says, so if you buy saving bonds through Treasury Direct, would you also be able to cash it in through the same agency when it matures? So the website talked about how you could cash it in, and when you go in there and open an account, you will be able to go in there and click on your bonds and sell how many you wanted to. It's just like selling a bond on TD Ameritrade, or just like selling a stock in TD Ameritrade. So yes, you would be able to go in there and redeem. You're going to be redeeming your bond with the federal government.
Okay.
Now, some bonds, some corporate bonds, the bond issuer can call it in early. So you buy, it's supposed to mature in 2 years. They may say, you know what, interest rates have gotten lower. We're going to call these bonds in. And they give you your money back early. And, they go and issue another bond at a lower interest rate. So bonds are callable or non-callable. And that's something you have to deal with when you're dealing with individual bonds. The bullet shares and the I bonds, they will manage that for you. It's invisible to you.
Okay.
And I don't know enough about bonds to know, it's called, it is considered a risk. So let's say you bought a 5-year bond and you're depending on that income at, you were getting 8%, you're depending on that 8% for 5 years, and they call it in at 2. And you do something else for the next 3 years. You're gonna have to find someplace else to put that money. Interest rates are now lower, and you may not be able to find another 8% that you're comfortable with.
Right, okay.
Non-callable bonds are better than callable. U.S. saving bonds, the government, they're non-callable. They're not gonna call you up and say, oh, you gotta redeem your bond. Now, you determine when you want to redeem it early or redeem it at maturation or roll it into the next series of bonds. Okay.
Okay. So with a bond, you wouldn't have the option, like we were talking about the put, having that added protection. You don't have an option to do put on that, like pay a premium so that you could sell or redeem that bond at the same. You can't do that. You can't guarantee.
That's an interesting question. I have to look into that.
Okay.
You want to be able to redeem your option for the amount that you bought it for.
Right.
Yeah, I'll take a look at that. So that
I just thought about that because you was talking about the put and how we don't think anything of it. I mean, we have insurance on just about everything else, but I never thought about having insurance. You're the first person that has even mentioned that as far as investing and trading. I've never heard, hey, get some type of coverage. So just in case, I knew it was involving risk, but I never even knew that anything like that existed.
Yeah, that's why options were created. So
Okay.
you could insure your it wasn't intended to be the speculative device that it is.
Mm-hmm.
But now, but it is you can insure a a position that you have where you want it to go up to make money. Now the call option, remember I talked about how you can sell something at $100 and buy it back at 50?
Right.
If I buy a call option, I get the right to buy a stock. So let's say the stock's at $20 and I buy a call option at 20.
Okay.
The stock goes up to $50. I have the right to buy that stock at 20 and I can turn around and sell it at 50.
Okay.
Call option makes money when the stock goes up, but it also protects me if I short a stock.
Mhm.
If I'm trying to make money from a stock going down, so I sell it at 100. If I buy a call at 105, let's say, and that stock jumps up to 150, I have the right. I don't have to go buy this stock at 150 because I own a call. I have the right to buy it at 105. I lose $5. So what? It's better than losing $50. You know what I'm saying?
Yeah. Yeah.
So, but yeah, so they were created as insurance, allow us to insure positions. And other time when IRAs wouldn't allow you to use options,
Okay.
but that has changed.
Mhm.
Once you have to prove to the broker that you have education about options and that your risk tolerance is, if you put that you're conservative, they're not going to let you trade options, even in a non-IRA account. But if you demonstrate that you have been trained and you have practice with options, they're more likely to allow you to use options in IRA because options cost so much less. You're risking less money. If you're risking less money, they're actually less, they're not as risk, is more risk buying stock than it is option. The problem with options is that their price is impacted by more than what that stock is doing. Okay. And like I said, there's lots of education that you need to get on options before you use them. But I will find out about protecting bonds. That's a great concept. We should go into business doing it. If it's not out there, make it so, because people would pay you for insurance.
That's true. That's true.
So I gotta believe that it's out there. I'm gonna look that one up. Any other questions?
Hi, I have a question. It's my first time on the call. I'm sorry that I hate that I missed the first couple of weeks, but it was interesting that you said something about the insurance. Because like when I was around that age, I bought long-term or term insurance. And so I think that's very interesting that you shared that information. And if I would have known what I know now, maybe I would have went into a different direction when it comes to the insurance.
Well, now the term costs less than insurance, okay?
Right.
And you may be able to get, if it to compete with cash value, term came up with term and you get a rider to get all your premium back if you don't die. So if you're gonna get term insurance, I would get a rider that return all my premium if I don't die, okay? Most cash value, like I have a whole life policy that at any time I can get all my premium back and the policy is over, but I can get all my premium back at any time. So I have insurance on me in case I die. So my wife can be a beneficiary. Let's say my wife dies before me. I don't need as much insurance. I just need enough insurance to put me in the ground. So I can say, you know what? I want all my premium back. And I want to reduce my coverage to, a burial policy, $15,000 to put me in the ground, So now there are a financial institutions that will tell you to get term and invest the difference. And the challenge of that is most people won't invest the difference. And most of the people that are the salesmen who are trying to tell you buy term and invest the difference, they ain't investing the difference. I recommend when you sit down with a financial advisor, you're about to share all your finances with them. They need to share with you. Ask them personal questions about How's your life insurance? How you got it structured for you and your family? Do you have term and are you investing the rest? You know, how much was your return last year? You know, how long have you been doing this? You know, is it working for you? Because the buy term and invest the rest make these great assumptions that you're going to get 8% or 9% a year for 40 years. And I bought a whole life policy January 2001. And I went and said, okay, let me see. It's almost been 20 years, you know. Next January will be 20 years. And I went and saw how much had the market gone up over that. The average return of the market over those, when I did it was 19 years, it was like a little over 5%. So using a real life example, that 8 or 9% they talk about didn't show up. It was 5%. And so unless we are engaged in financial markets, you're not going to get 8 or 9% unless you educate. It don't just happen because you turn your money over to a mutual fund. It doesn't happen like that. The people that get, you know, 10, 12, 14, 8, 9, they have learned something about financial markets and they have financially educated themselves and they have their money working in different aspects, different locations. And then they start somewhere, you know what I mean? I had an opportunity I went in the Navy in 1978. In 79, I had an opportunity to get a cash value life insurance policy that was paying 13%. And the math didn't add up for the first 2 years. And I kicked myself in the behind all the time. Had I gotten that, I could have put a lot of excess money in there, and that cash value product would have been, you know, just like an annuity is today. You understand what I'm saying? So life insurance is, I think, the first investment that a young person should make. And we all need to, you know, take a look at where we are with it. It can benefit us. And I prefer independent financial advisors instead of those that are captive. A captive agent works for a company and they can only talk about what the company offers. And their company may not have a annuity that pays you a fixed rate of 5%, or some annuities will, if you give them $100,000, they will add $14,000 to your account. Now, the annuity company hopes that when you reach a retirement age that you annuitize your money. You know, it grows in there. They don't want you to take the principal out. They want you to annuitize it because most of us are going to outlive the annuity. And while you're giving them your money, the insurance company is investing it. Insurance companies are very good at investing money. If you notice during the Great Recession, lots of banks almost went under, okay? There was only like 1 or 2 very small insurance companies you never heard of. AIG stopped being an insurance company and tried to be like the banks. That's why they got in trouble. They stopped being an insurance company and started investing in the things that Goldman Sachs was investing in, that Merrill Lynch, that Bear Stearns was investing in. And they got away from doing what insurance companies do. Insurance companies know how to make conservative investment. And so AIG was the only insurance company that got in trouble. And that's because they stopped being an insurance company. They started trying to be an investment bank. But all the other ones, State Farm, New York Mutual, none of them were in trouble. Just like credit unions. You didn't hear about any credit unions going on there because credit unions stuck with the basic things, making, loaning mortgages and small business loans, and stop trying to get into those fancy financial products that Bank of America, Citibank, all of them start trying to be investment banks. So insurance companies and credit unions did not fail us during the Great Recession because they stuck with some very basic things that they're good at. And so that has helped shape my views on some of these things. You know what I'm saying?
Yes, thank you so much for sharing.
All right, well, the other 2 presentations are available on YouTube. if you would text me or email me your phone number or email address, I'll send you the links and you can watch the other two presentations.
Okay, I'll send it over.
Now, my biggest goal in doing this is I don't know, there's specific things that you might want to know. As you can see, it takes time to develop a skill. Trading or investing is a skill. It's going to take time. It's going to take study. It's going to take reading, and a lot of stuff is available online today. And I'm available for one-on-ones for specific things, or I'm gonna do these little the month of June, July, and August. I'll be doing a course at church called Foundations, which is about foundations in Christianity. So I won't be available on Thursdays, but I'm available. I'm not available on Wednesdays, but I can be available on another night if 2 or 3 people want to talk about something. Y'all just shoot me the information. Okay, well, thank you. I see that. So I will copy this before I get off, and I will be able to reach out to you. Hang on, let me copy it now. So I have copied that.
Sorry, I put the wrong number the first time. I hit too many numbers. So the last number is correct.
Okay, let me go back in there then. Okay. All right, so I will send you the links to the presentations, and I'll send you links to the video and the presentation, because the words, I've tried to use words that you need to become familiar with. They need to become second nature to you, and you'll learn, and you'll find out what it is you really like. So next week, is there anything in particular that you all want to see or discuss next week besides can we protect our bonds? Can we insure our bonds?
You talked about last session, Elder Frank, you talked about before you start any type of investing, you would recommend that you do some virtual trading. And you mentioned the sites, and you said you could set up a profile or whatever. Also, you mentioned before you get into that, you need to make sure that you are some of the, I think we talked about high interest credit and revolving debt. You were saying before you start any kind of trading, you really need to work on, canceling that debt and getting rid of some of that debt. Maybe if you could, I would be interested in maybe discussing or listening to you, kind of guide us with some of the things that maybe we want to take a look at first, or something like that.
Okay, so you're right. Emergency fund, debt elimination. So trading is part of your financial plan.
Right.
The plan should talk about where my money is coming from, where my money is going, how I'm going to fill up my emergency fund, how I'm going to get rid of my debt. So we can take a little closer look at emergency fund and debt elimination. So maybe I'll introduce. I have this thing that's called the financial house. I'll introduce the financial house.
I appreciate that.
Which talks about that.
I think that'll be a good point also. That's what I would like to see. Like I said, I know I missed the first 2 classes, but I think that's a great point. Like she said, how do you eliminate the debt so you can start investing into the stocks, into those things that you're speaking about.
So realize that while you are building up your emergency fund, while you're eliminating debt, you are studying trading and investing. You're learning.
Okay.
It's not you're not wasting time by doing that. Because there was some person on the call when I answered, they asked, "You mean I got to have an emergency fund before I trade?" I said, "Yes." They're no longer here. They left.
Yeah.
got out of the call.
Yeah.
You need to start learning now.
Mhm.
And so while you are building up emergency fund, eliminating debt, learning to save, you know, that's when you take the time to learn, because it's going to take years before you become a successful trader, because most people don't take the time. You can open up a brokerage account in like 10 minutes and you fund it, that someone will make that money available to you. As you know, when we transfer money between banks, it used to take 2 or 3 days. Some of these brokers will make that money available to you just like that. Say, hey, go trade. They make money when you trade. Okay. Now, some of them, I believe, now Charles Schwab has education. And TD Ameritrade has education. I don't know about E-Trade, but if you are successful, they are successful. So some of them, they want you to succeed. And am I still on?
Yes.
Okay, my computer just jumped around like crazy. So you see my chart right now, don't you?
Yes.
So this is a chart that I use. I have some that are a lot more jumbled up than this, but they all means something to me. Your chart, if you choose to be a technical trader, will have its own look. It'll be unique to you. You know, you may like everybody. I can't see what other traders. Some traders have. I've listened to their way of trading, and I just can't see it. But I can see what I see. Okay, and it's been meaningful to me as of late. And all these little lines, they all mean something to me. And it's taken years for it to be meaningful, okay? Let me see if I can just show you one quick thing about trading. So let's click on this one. And I'm gonna click on that. Let me blow this up a little. So first, this line up here at the top, I have noticed that when this blue line goes above this green line, so the blue line went above the green line right there. And you see how it continued, kind of sort of continued going up. As long as that blue line stayed above the green line. Now, once the blue line goes below the green line, it went up, but I didn't make a new high. All these other times it went down here, it made a new high. See, it went down here, made a new high, made a new high, went down here, made a new high, went down here, did not make a new high. So my trading could be as simple as, if this blue line goes above the green line, to buy and hold it until it drops below the green line again.
Mm-hmm.
And be happy with the amount of money I made. So let's say it went above it right here, and it closed at, let's call it $116. And then here it dropped down and it's let's call it $127. So that's $11 a share. And it happened over a period of 27 trading days. So that's a little over 6 weeks. Okay, so it can be that simple. It can be that simple. And the simpler it is, the better. And that's part of my problem. See, my problem is, I can show you, let me show you another chart and then we'll get off of this. Because wife would beat me up if I show you too many charts, because she don't like my charts. Look at this one. Look at all that stuff. It all means something to me. Now, let me show you something about this one. Okay, here's that green line again. It goes above that green line. It's the same indicator. But every time this purple line gets down here to 0, man, that'd be that's buying low. Look at that, it pops up. Here it is again, it popped up. Here it is again. Here it is again. It popped up. Here it is again. But over here, the green line is less than this green line, and it didn't make a new high. So one strategy could be, if this green line I wait for the purple line to go to 0, and then I buy. That's a nice low to buy from. And there I'm buying at, let's say I got that at $111. Getting out at the same time now. Come on, there we go. So I'm in for 21 days. So I bought at 111 this time, got out at the same 127. So that's $16. So this is a better buy. I would have made $16. Over here I bought and I made $11. Over here I bought and I made $16. Why not do both? Buy there and there. Because it doesn't always come back. Sometimes it goes and just takes off, okay? And every time it pulls back, buy, keep doing it. And here, I can't do it because the purple is 0, but this green is not above that green. So trading can be that simple. And that's how simple it should be. All this other stuff down here, like a very simple way is you can buy it when it turns green and sell it when I get 2 down red. So that's 1 down red, but that one's up. 2 down reds consecutive. So nope, I ain't gotta sell it. Nope, that's 1 down red. So I keep holding it. That's 1 down red. That's 1 down. That's 1 down. So I would still be in this position. I would have bought this at, well, this is about, let's say I got it at 115. And I would still be in it at 134, waiting for 2 down reds. It can be that simple too. And that's what I was going to show you next week. You're just waiting for a color change. To be coming off this lower blue line. Like you could buy there, but the initial buy is the first green coming off once you rise from this bottom blue line. And then you're waiting for 2 down reds, 2 back to back, and we haven't got it yet. And trading can be that simple. And this is a daily chart, so you don't have to come and look at the chart like after 3:30 to see what color it is. If it's it's red, I got a down red, and this was a down red, I would just get out. But this one is up. This is an up candle. It opened here and it closed up. It's 2 reds, but I want 2 reds to be down. You know, trading can be that simple. And this is on an ETF. This is an ETF that tracks semiconductors. It had almost over 5 million shares today. It's up 2.8% today. And I like this ETF. It has a tendency to rise when it does that. It has a tendency to go up after it does that. Like more than likely, believe it or not, I think this thing on, but we'll see. I never know what the market is going to do tomorrow. I evaluate what is the market doing today, and I make my decisions based off of my rules. Like if I got into this thing because this is the first green rising from this blue light right here is a green, I would have bought right there, but it turned blue. It turned blue. Here's a red. Now there are rules about if I ever drop below the low that I got in at. So I would have got out right here. Would have lost quite a bit of money if I was trading the stock, but the way I trade options wouldn't have been losing quite a bit of money, okay? But it can be that simple, especially if you limit yourself to a small basket of stocks. If you're not out there trying to look through 15,000 stocks and ETFs to find that, you know, limit yourself, especially in the beginning. I recommend that in the beginning, you practice on just SPY, the Standard & Poor 500, that you just practice on it. And you see it did the same thing. It popped up, didn't quite make a new high, and is back down again. But you don't have, this green line is not above that green line. So I wouldn't buy that. Now, if I was down here doing the green, I would have bought here. Here's 1 red, 2 red, but this is an up red. So I'm still waiting on the two reds. And you could actually do both of these. I could have a position based on this, and I could have a position based on this. And when this one occurred, get out of this one and continue to hold this one, because you never know what the market's going to do tomorrow. I just don't know. You may find that you have to change your rules a little bit. So, okay. So I had, maybe if I get 3 reds, I'm out no matter what. Okay. Whether if I get 3 reds in a row, I'm out no matter what. Some people look at this orange line. The moment it points down, they get out. It can be that simple. Once I rise above that orange line, the moment it points down, I get out. Rise above that green line. If it's that orange line points up, I get in. It points down, I get out. It points up, I get in. It can be that simple. And you just have to find a strategy that you can see. You go and you know, look at charts, old charts. Don't go back too far. Go back about 5 years at the most. And then start practicing it real time and see if you're able to make money that way, doing it on paper or using a virtual tool. Now, I called Charles Schwab. They do not have a virtual tool for you to use for trading. TD Ameritrade will let you open up an account. You don't even have to put money in it. And they have a demo platform, and I'll show that next week. And I don't want to hold y'all forever. I'll talk about this stuff forever. So next week, we'll look at the financial house, which talks about emergency fund, debt elimination, and I'll show you a trading platform, and we'll look at using just a little color thing that I talked about, okay? And Miss Nikki, I will send you the links to the previous presentations and the videos. And I want to thank y'all for spending your time with me. Okay?
Okay, thank you.
Thank you.
All right, y'all have a wonderful evening.
All right, you do the same.
All right, bye-bye.
All right, bye-bye.
Okay. Hold on, sweetheart. Hold on. I'm trying to. Be a way I can save the chat. All right, let me go and stop the share. Thank everybody. We're ending the video now. Have a wonderful time.